A 65-year-old holding $500,000 in cash could see its real purchasing power slashed to just $277,000 by age 85 without spending a dime. That's not a stock market crash, that's the guaranteed silent loss that comes from holding cash year after year. There's a hidden mechanism that turns cash into a slow wealth destroyer for retirees, and most people never see it working. Meet Mark, 65, newly retired with $600,000 sitting in a savings account earning near zero. He thinks he's playing it safe. But behind that comforting balance lies a mathematical certainty. Every day, every month, that pile shrinks in what it can actually buy. If you want the real story behind money, subscribe now. Let's get into it. Let's start with the mechanism. The dollar you stash today will not be the same dollar 10 years from now. The Federal Reserve actually targets that decline. The Fed aims for 2% annual inflation, but since 2000, the cumulative erosion has been over 45%. A $100 bill from 2000 buys only about $55 worth of goods today. That means Mark's $600,000 measured in year 2000 purchasing power is already worth just $330,000, and it's still melting. Now consider, Mark needs to withdraw $40,000 a year adjusted for inflation, with no growth on his cash. Simple math tells a brutal story. At 3% inflation, keeping his spending constant forces him to take larger and larger chunks out of a static pile. He's like a man bailing water from a boat that's taking on water faster. The numbers, starting with $600,000, withdrawing $40,000 in year 1, then $41,200, then $42,436. His cash runs out after just 12 and a half years, not 15, not 20. Life expectancy for a 65-year-old is roughly 20 more years. So Mark faces 7 to 8 years with nothing, all because inflation quietly demolished his safety net. That's just average inflation. What happens when inflation spikes like it did in 2022? In June 2022, US inflation hit 9.1% year over year. In a single year, every dollar lost 9 cents of purchasing power. For Mark's $600,000, that 1 year alone shaved off over $54,000 in real wealth. Then 2023 added more, compounding the wound. Over the 24 months from January 2022 to December 2023, the dollar lost roughly 10% of its value. That's a $60,000 haircut for Mark without a single withdrawal. Now imagine Mark had retired 5 years earlier in 2018. Cumulative inflation since then tops 20%, meaning his cash pile lost a fifth of its buying power before he even touched it. So why do retirees cling to cash? Because it's sold as safety. No daily price swings, no red numbers on a statement. The losses are invisible until you try to spend. Financial advisors call this the inflation illusion. The nominal balance never changes, so you feel secure. But the real balance, what it can buy, is in free fall. Let's frame it with an analogy. Imagine a gas tank that never leaks, but every year the pump adds a chemical that reduces the miles per gallon. The tank looks full, but you get less distance each time. Cash in retirement is exactly that tank. The number of dollars never leaks, but each dollar takes you fewer miles down the road of retirement. For retirees, the pain is even sharper because their personal inflation rate runs higher than the headline CPI. Healthcare, for example, has historically climbed 5% to 6% annually. If Mark needs $10,000 a year for out-of-pocket medical costs, a 5.5% medical inflation rate pushes that bill to $17,000 in 10 years. Cash won't stretch that far. So the double whammy. Cash not only fails to grow, but the very things retirees actually buy, healthcare, housing repairs, insurance, are inflating faster than the average. This isn't a fringe risk. Federal Reserve data shows that a huge slice of retiree portfolio sits in cash, often the very dollars they'll need to live on in 15 or 20 years. For a typical couple with $250,000, a 3% annual inflation hit is a $7,500 loss in buying power the first year, and that loss compounds. Over 25 years, they'd lose over $100,000 in real terms. And here's the kicker. Unlike your working years, you can't just earn more income to offset inflation. Retirees are on a fixed nominal budget unless they own assets that adjust. Every dollar in cash you hold past your immediate needs is a bet that inflation will stay lower than what you could earn elsewhere. Historically, it's a losing bet. The real risk isn't a stock market dip. It's a slow, quiet, guaranteed evaporation of your life savings while you're told you're playing it safe. So the question isn't, is cash safe? The real question is, safe from what? Because from inflation, cash is the most dangerous asset you can hold. Linda retired at 65 with $500,000 parked in a savings account paying 0.5% interest. On paper, every month her balance stayed steady, or even ticked up a few dollars. But 3% annual inflation was silently eroding what that balance could actually buy. After just 1 year, her real purchasing power dropped to about $487,500, a $12,500 loss. Fast forward 10 years, and that same $500,000 would only buy what $390,000 can purchase today. By year 20, her purchasing power shrinks to roughly $300,000, a 40% decline, while the statement balance barely moved. If Linda lives to 90, after 25 years the real value plunges to just $265,000. She lost almost $500,000 of future spending without a single market downturn. Meanwhile, her neighbor Tom also retired at 65 with $500,000, but he invested in a low-cost balanced portfolio. Using a conservative real return of 4%, Tom's portfolio grew to over $1 million in today's purchasing power. At the historical 5% real return of a classic 60/40 stock bond mix, his nest egg compounded to over $1.3 million. The difference between $265,000 and $1.3 million isn't about luck, it's about the silent tax of inflation on idle cash. Cash is not a savings vehicle. It's a transactional convenience whose value melts over decades. Think of inflation as a leaky bucket. Holding only cash means you're plugging the holes with your future self's money. Every 1% of inflation above your after-tax interest rate drains your purchasing power by 1% per year, compound interest in reverse. In the 1970s, US inflation averaged 7% annually while savings accounts paid under 5%, devastating cash wealth for a decade. From 2021 to 2023, consumer prices jumped over 15% cumulatively, silently amputating the real value of cash hoards. The psychological trap is that cash feels safe because the nominal dollar amount never drops. But safety isn't measured in digits on a screen, it's measured in the groceries, healthcare, and rent. Those digits will buy 20 years from now. Linda's biggest risk wasn't a bear market, it was a quiet robbery that never made the evening news. To outrun inflation, your dollars must work. Owning shares of businesses, real estate, or bonds that adjust with rising prices. Take TIPS Treasury inflation-protected securities. Their principal rises with CPI, guaranteeing your purchasing power is maintained. As of early 2025, Series I savings bonds offered a fixed rate above inflation, backed by the US government with zero risk to principal. But even TIPS and I bonds are just preservation tools. They won't multiply your wealth beyond inflation. To build a retirement that outlasts you, you need growth assets that generate real returns, stocks, rental properties, or diversified funds. A practical rule is to keep 2 to 3 years of living expenses in safe liquid cash and invest the rest for growth. That cash buffer shields you from selling during a market dip, while the growth engine compounds ahead of inflation. The cost of waiting is the most underestimated risk in retirement. Every idle year lets inflation eat what compounding should have built. Rule of 72: at 3% inflation, your cash's buying power halves in 24 years. At a 7% real return, invested money doubles in 10. So the question isn't whether you'll run out of cash, it's whether your cash will run out of purchasing power before you do. Next, we map out exactly how to structure that buffer to growth split. Meet John and Linda, both 65. They just parked $750,000 in a money market fund earning 0.45%. On paper, they feel safe. The statement shows a balance that never goes down. But in 2022, the consumer price index rose 8.0%. That $750,000 lost $60,000 in real buying power in 12 months. Their interest yield, about $3,375, didn't even cover a tenth of the whole inflation drilled into their nest egg. Cash illusion is the trap. The number on the screen stays the same, so the brain thinks wealth is stable. But a dollar today is not a dollar tomorrow. Inflation is a slow puncture, not a crash. Since 1913, the US dollar has lost over 96% of its purchasing power. A 1913 dollar buys just 3 cents worth of goods today. Even at the Fed's 2% target, prices double every 36 years. A $50,000 annual withdrawal needs to become $100,000 to keep up. Now, let's run John and Linda's retirement with a 3% average inflation rate, the 100-year US average. They pull 4% a year, $30,000, and adjust for inflation. After 15 years, they need over $46,000 for the same lifestyle. Their all-cash portfolio, earning next to nothing, would be drained to zero a decade faster than a balanced portfolio. This is the silent sequence of returns risk nobody talks about. Inflation is a negative return you accept every year without a line item. Imagine a leaky bucket. Even if no one steals a single drop, half the water is gone by the time you reach the garden. From 2000 to 2020, the S&P 500 returned 6.0% annually after inflation. Cash in a typical savings account returned negative 1.5% per year real. Over those 2 decades, $100,000 in cash would buy what $74,000 did in 2000. The same $100,000 in a simple index fund grew to $320,000 in real terms. This isn't about chasing yield. It's about recognizing that safe principle is a myth when the yardstick itself is shrinking. The worst part? Retirees often don't notice until their mid-70s when a cart of groceries suddenly feels like a luxury. That's because inflation compounds just as relentlessly as any stock return, but against you. A 65-year-old with $500,000 in cash might feel wealthy. By 85 with 3% inflation, that $500,000 spends like $276,000. Meanwhile, a retiree with 60% in equities and 40% in bonds historically would have seen their real wealth grow, not shrink. Why do we do it? Behavioral economists call it myopic loss aversion. The pain of a 10% market dip feels sharper than the abstract pain of a 3% purchasing power decay. Your amygdala fires when your brokerage balance drops $40,000. It stays silent when your grocery bill rises $300 a month. Yet that silent $300 adds up to $36,000 over a decade, far more than many one-time market losses. The antidote isn't zero cash. It's matching cash to near-term needs and letting the rest fight inflation with assets that have pricing power. A simple treasury inflation-protected security, or TIPS, adjusts its principal with CPI. If inflation jumps 5%, the bond's par value jumps 5% before you earn interest. For John and Linda, building a 10-year TIPS ladder for essential expenses would immunize that portion from the stealth erosion. Beyond TIPS, companies that sell necessities, utilities, consumer staples can pass rising costs to customers, protecting your purchasing power. But here's the counterintuitive kicker. Too many retirees hold cash waiting for the right time to invest, and that wait becomes permanent. They sit on $600,000 for 7 years, miss a 40% market run, and lock in a negative real return that guarantees a smaller life. Cash is not the villain. Over-allocating to it, out of fear, is the slow-moving retirement killer most advice misses. The US dollar has lost more than 96% of its purchasing power since the Federal Reserve was created in 1913. That's not a typo. A dollar today buys roughly 4 cents worth of what it did in 1913. Even at the Federal Reserve's long-run target of 2% inflation, cash sitting in a zero-interest account halves in real value every 36 years. Now meet Jim and Linda, both 65, who just sold their business and parked $1.2 million in a money market fund yielding 0.5%. After 10 years of 3% average inflation below the 50-year average, their $1.2 million will only buy what $893,000 buys today. That's a $307,000 haul vaporized just from sitting on the sidelines. Meanwhile, a simple 60/40 portfolio of stocks and bonds, which historically returned about 8% nominal, would have grown that $1.2 million to roughly $2.6 million. Jim and Linda didn't avoid risk, they just traded market risk for the guaranteed erosion of inflation. Retirement can easily last 30 years. A dollar today needs to buy a carton of eggs 3 decades from now. In 1994, the late financial planner William Bengen published the now famous 4% rule, based on a portfolio of 50% to 75% stocks and the rest in intermediate-term treasuries. An all-cash portfolio had a 100% failure rate in Bengen's 30-year retirement simulations, even with low inflation. That's because cash produces no real return, and you still need to withdraw spending money every year. A dollar earned in interest is fully taxable as ordinary income, so a 0.5% yield in a 22% tax bracket becomes a net loss after inflation of 2.6 percentage points. You're paying the government for the privilege of watching your purchasing power disappear. Behaviorally, we find comfort in a stable account balance, mistaking nominal safety for real safety. This is called the money illusion. Your brain fixates on the number printed on the statement, not the number of groceries it can buy. Think of cash as a leaky bucket. Water drips out so slowly you don't notice until the drought has already set in. Inflation also isn't uniform. Healthcare costs for retirees have risen about 5.4% annually over the past 20 years, far outpacing headline CPI. A typical 65-year-old couple retiring in 2023 will need approximately $315,000 just for out-of-pocket medical expenses, according to Fidelity's annual estimate. If Jim and Linda's cash earns 0.5% while healthcare inflates at 5%, their medical purchasing power halves in less than 15 years. They'd need $630,000 2 decades later just to cover the same basket of medical goods. So cash isn't just indifferent to inflation, it actively conspires with it by offering no growth engine to outrun surging sectors. Jeremy Siegel's classic data shows that over any 20-year rolling period since 1871, US stocks have outperformed cash in real terms 96% of the time. That's not a prediction, it's a historical fact. And the few exceptions occurred after extreme bubbles like 1929 or 1999. Even 30-year treasury bonds with all their interest rate volatility have delivered a real return of about 2% per year since 1900, while T-bills returned less than 1% real. The first step out of the cash trap isn't to dump everything into the S&P 500 tomorrow. It's to recognize the real enemy isn't volatility, it's time. One practical bridge. A ladder of Treasury inflation-protected securities, or TIPS, which guarantees your principal grows with CPI and pays a small real yield on top. As of late 2024, 5-year TIPS offer the real yield around 1.7%, meaning your buying power actually increases year after year, risk-free. Combining 2 to 3 years of living expenses in a TIPS ladder with a low-cost, globally diversified stock and bond index fund attacks both inflation and longevity risk simultaneously. Jim and Linda's real crisis wasn't inflation, it was the false belief that standing still was the safest move when in fact it was the most expensive bet they could make. Over the past century, $1 stashed in a mattress has lost 97% of its purchasing power, while $1 in the S&P 500 compounded to over $600. That's the difference between a nominal dollar that just sits there and a real dollar that works through every recession and boom. Picture a retiree named Susan, with a $1.2 million nest egg, $700,000 of it parked in cash for safety. At a 3% annual inflation rate, her cash pile's purchasing power will nearly halve in 24 years, even though the balance never drops. This is the invisible yield, a negative compounding that never shows up on a statement but shrinks her grocery basket year after year. Meanwhile, the $500,000 she deployed in a balanced portfolio historically doubles every decade, while her dead cash just marks time. Calling cash risk-free only considers default. It ignores the grinding certainty that your money buys less tomorrow than it does today. Run the math. If Susan pulls 4% a year from an all-cash pile, after inflation she drains her real spending power twice as fast as a 60/40 portfolio. Simulations from the Journal of Financial Planning show a 20% cash allocation surviving 30 years with 95% certainty, while a 50% cash stake fails nearly a third of the time. The reason is brutal. Heavy cash leaves no recovery engine when early retirement years deliver negative stock returns. Sequence risk becomes fatal. Inflation doesn't just nibble, it avalanches. A 3% rise each year means a $50,000 annual withdrawal needs $90,000 in 20 years just to keep the same lifestyle. Think of cash in retirement like a wooden bucket with slow leaks, safe to carry but empty by the time you reach the well. Even 3-month T-bills, which recently offered 5%, slipped below 2% after a 3% inflation and a 22% federal tax bite, barely treading water. Freeze a $500,000 cash position for 25 years at 3.5% inflation, and you're left with the lifestyle of just $212,000 in today's money. The true danger isn't just arithmetic, it's the emotional illusion that a stable account balance equals financial peace. When that illusion cracks and the portfolio is too thin on growth assets, retirees panic sell at the worst possible moment, locking in permanent losses. Since 1926, US large company stocks have outpaced inflation by over 7% annually, while treasury bills barely squeaked out 0.5% real return across the same decades. Every extra percentage point allocated to cash exerts a constant drag, reducing a portfolio's 30-year annualized return by roughly 0.12% for each 5% shift out of equities. Liquidity isn't the enemy. Carrying 5 years of expenses in cash when 2 years in a rolling bond ladder would suffice is the silent wealth killer. Advisors call the decade surrounding retirement the red zone. Overcaution here amplifies longevity risk far more than a market correction ever could. Vanguard's framework suggests retirees rarely need more than 2 years of spending in true cash equivalents. The rest belongs in assets that breathe. Social Security's COLA already hedges a base income stream against inflation, so layering massive cash on top just duplicates a protection you already own. Staring at a $250,000 sit on the sidelines waiting for a 20% market dip that might take 5 years to arrive is a wager where time is your adversary. From 1973 to 1982, inflation averaged 8.7%, a $100 grocery trip vaulted to $230. Cash savers lost half their real wealth. Equity investors eventually broke back even. The rule of thumb, 3 years of expenses in cash, ignores that expenses aren't static, they inflate, making that cushion a shrinking fortress. For anyone planning a legacy, a cash hoarding strategy bequeaths dollars that have been sandpapered by decades of inflation, a diminished inheritance. Instead, a tiered approach puts 6 months in a high-yield savings, a few years in short-term tips, and the rest working in a globally diversified engine. The psychological hurdle is separating sleeplessness from genuine risk. Volatility is rent you pay for purchasing power, not a fine for bad behavior. Most retirees find the sweet spot between 10% and 18% in cash and cash-like instruments, preserving dry powder without sacrificing a real income stream. But there's an even subtler enemy than inflation alone: the way taxes can turbocharge the loss on cash you've already paid tax on, which we'll expose next. A retirement portfolio stuffed with cash loses roughly 3% of its real value every single year, not in a crash, but silently every day you sleep. Take Linda, 65, retiring with $800,000 parked entirely in cash. At 3% average inflation, her nest egg's buying power shrinks to just $590,000 in 15 years, a stealth tax of over $200,000. If Linda pulls $40,000 annually, that all-cash cushion runs out 8 years earlier than she assumes, because inflation forces her to withdraw more dollars just to buy the same groceries. The deeper wound is that even a high-yield account paying 4% delivers roughly zero real return after taxes and inflation, guaranteeing permanent erosion. So how much cash is enough? The research-backed sweet spot is 2 to 3 years of living expenses parked in a safe liquid bucket, never your entire portfolio. For Linda, that means $80,000 to $120,000 in a treasury money market fund currently yielding around 5%. That's her shield, not her engine. The remaining $680,000 goes into a globally diversified portfolio: 60% low-cost stock index funds, 40% intermediate bonds built to capture a 6-7% historical nominal return. After subtracting 3% for inflation, that mix has historically grown purchasing power by 3-4% per year, letting Linda take her inflation-adjusted $40,000 without eating principal. Over 30 years, shifting from all cash to a cash-plus invested bucket can be the difference between running dry at 82 and leaving 6 figures to her grandkids at 95. The real danger isn't market volatility. It's the permanent loss of buying power that feels safe because the account balance never goes down. Cash stays flat, prices don't. Right now, open your retirement statement and calculate what percentage of your assets sits in cash or money market funds. If it's north of 10-15% of your liquid net worth, you're leaking future freedom. That quiet leak is why the retiree who plays it too safe with cash often ends up poorer than the one who embraced a reasonable dose of investment growth. The math is stubborn, but the fix is simple. If that truth hit home, give this video a like, it helps others escape the cash trap. Drop one number in the comments. What percent of your retirement money is in cash right now? Subscribe and tap the bell so you don't miss our next deep dive, how a single fee inside your 401k could swallow 30% of your final balance. I'll see you in the next one.